All right. Thanks everyone for coming. Delighted to be here today and present some research that's very much in progress and I hope somewhat also relevant to this audience. This is joint work with Farzad Saidi at Stockholm School of Economics and Benjamin Wirth, who's at the Statistical Institute in Germany, in Nuremberg. I'm Professor Christian Moser, I should say. I'm in the economics division here at Columbia Business School. I'm a macroeconomist, and this project is on a sort of traditional macroeconomic issue. That is, what are the consequences of monetary policy? But it comes with a twist, and I should say at this point, the twist here is that I'm looking at distributional consequences of monetary policy. Now, as all of you guys will know, having taken either my class or something similar here at CBS, you know that monetary policy is thought of as one of the key tools to stabilize an economy, bring it back on track when we are entering a recession or when GDP growth is below trend, or when unemployment maybe is very high. And so if you look around the world, you know, many central banks around the world essentially have as a target, as a goal to use monetary policy in order to stabilize the economy. But stabilizing the economy in practice usually means, one, bring GDP or unemployment back to trend, and two, keep inflation under control. And what's often neglected in this discussion is maybe that some people may benefit or be hurt by this policy more than others. Hence the distributional consequences that I want to explore in this project. So what's the motivation for this piece of research? You look around the world and you might be aware that in just about any OECD country over the last couple of decades, income inequality has been going up. That means usually that the rich already, 20 years ago are even richer now, and that people at the bottom of the income distribution have not seen the same gains as those at the top. Against this backdrop, there's a more recent literature, and I talked a little bit about this in my class last year, that focuses on your workplace as a key determinant of how well you will do in your life. That is to say, getting the same degree from the same university with the same qualification and having the same years of experience in the labor market and all of that still is not enough to give you security in your professional lives. What really matters, it turns out, is where you start out working and where you end up working over the trajectory of your career. So that's our starting point. More recent descriptive evidence has pointed out that the firm, or your employer, is also an important unit of analysis in understanding trends in both within firm and between firm inequality in pay. That, differences between firms, for example, are quite substantial. They pay quite differently to begin with, and that these pay differences have been changing over time in drastic ways. Now, against this backdrop, what we want to look at in this paper is one particular determinant of wage inequality, and that will be the role of monetary policy, which may lead to credit supply, we argue, or long literature has argued, and hence credit supply in turn may affect the levels of wage inequality in the economy. So how does this work? Well, if you think about what does credit do to an economy, there's really two, I think, fundamental reasons why you think the supply of credit would matter. The first point is that credit supply affects the allocation of both physical and maybe also human capital in the economy. If you're an unconstrained firm, you want to expand, hire the talent, and buy the technology, build the kind of machinery capital that you would want in order to produce at the most efficient, productive scale. The second point is that capital is linked to both employment and also the returns to the kind of people that you hire. And what I mean by that is that capital fundamentally is complementary to many sorts of skills that are being increasingly demanded and put to use in nowadays labor market. It turns out that we know by now that especially high skill labor, that means those with an MBA and above especially, benefit a lot, become a lot more productive by having sort of the latest technology and more capital available to them. Relative to lower skill groups, where yes, capital may help at the margin, but maybe does not have the same kind of kick as at the top. So as a consequence of these two fundamental points, you may now sort of hopefully be convinced that looking into credit supply through these channels may be directly relevant for who gains and what kind of workers will be affected by credit supply. So in this paper, we want to look at the effects that monetary policy has on inequality through this credit supply channel. Now, just to give you a bit of background on where the academic literature is coming from in thinking about this issue, our basic view of the world, and I'm just sketching here sort of the underlying theory behind this that people use in academic circles, is we think about a world in which there are labor markets populated by many different people, some of different skills than others, and also firms that may differ in the kind of productive activity they engage in. Some of them may be very high productivity firms, some others may be very low productivity. They may coexist in the same market. Now, these firms are not only differentially productive, they may also differentially rely on credit supply from banks in order to operate their day-to-day business. Now, in this world, let's think what happens, let's think through what happens if I now change the credit supply to one of these firms in this economy, in this fictional world that we're thinking about. Well, the first point is that firms may adjust how much they pay their workers, or different workers may now gravitate towards different firms that now happen to have maybe more credit in order to hire these workers. So that will lead to a firm level effect on inequality that should show up as between firm differences arising in response to this credit supply shock. But second, as I alluded to before, credit may be differentially relevant to different workers within the same firm. So even if a given firm receives some amount of credit, that credit inflow may be differentially targeted or complementary to certain workers, maybe high skill, relative to other workers in that very same company. And so what I want to get across here really is that credit can have these interesting effects, changing both the distribution of pay between firms, but also changing potentially the distribution of pay within the firms. Now, when I talk about credit supply and monetary policy so far, I've been rather abstract. Now, here's the specific instance, and I want to almost call it a natural experiment that we want to exploit in this research project. As many of you may be aware, the European Central Bank back in 2014 introduced negative interest rates for the first time. What does that mean? That means from June 2014, and this lasts until right now still, as we speak, banks that are commercial financial institutions in the Eurozone that have deposits with the European Central Bank overnight actually do not receive themselves an interest rate on these deposits. They must pay the ECB for storing money with them overnight, which is kind of a weird concept that you have negative rates and then you got to pay for owning money. But we've discussed some of that in my intro macro class already, so many of you will be familiar with this idea. Now, it turns out that these negative rates will have quite different consequences to the normal, positive, maybe low rates that we have studied in my intro macro class before. How is that? Well, the basic mechanism that we all have in our minds is that lowering the interest rate will expand the credit supply because it makes it cheaper for everyone to get credit, and so there'll be more money circulating around in the economy. Now, it turns out that for various reasons, negative rates can have quite different effects. And what my co-author, Farzad Saidi, has shown in previous work is that these negative rates, for banks that saw themselves stuck with having to pay these negative payments now, paying the ECB for storing money with them overnight, actually have suffered from this policy a net worth shock that primarily affected those banks most exposed to the policy, namely those that had the highest deposit rates, meaning deposit-heavy banks felt the pressure from these negative rate policies. Now, Now, why are negative rates somewhat special? It turns out commercial banks are somewhat reluctant, or in practice unable, to pass on negative rates to us, the consumers, which is quite different to just lower positive rates, which your bank can always say, I'm going to offer you a lower rate as well. So that's sort of this quasi-natural experiment that we want to exploit here. The fact that all of a sudden, overnight, in the middle of June 2014, some of these banks now have to pay for their deposits, which makes it differentially likely for them to respond by giving or not credit. Now, what's the big idea? High deposit banks, we find, lend less overall. That means there's a credit contraction. Remember, those are the banks that need to pay for the deposits overnight. But it turns out that these same banks now concentrate their lending primarily to financially constrained firms, which also happen to be risky firms in practice, high volatility firms. So now we've sort of closed the loop, essentially. We see negative interest rates at the European level, and then some of these banks cut their lending overall, except maybe to some of the firms that are very risky and still, worth reaching for by these commercial banks. And so what we want to exploit is we want to see what happens to these firms that happen to be in a relationship where they happen to get more credit before and after June 2014. So preview of finding, we find a negative credit contraction, negative supply of credit shock in response to the negative rates in the Eurozone. And then we find interesting responses. We find that firms become more similar in how much they pay, but within firm pay, differences within firms go up, meaning there's more equality within the firm now. How does this come about? I want to tell you more step by step, but before doing that, let me tell you a little bit about how we set up our empirical approach, and I want to start talking about data. Quick data description. I think this is one of the super exciting parts about this project. We're putting together several new data sets in this research project. The first are administrative linked employer-employee data based on social security records from Germany between 2010 and 2016. What does this data allow us to do? We can follow every employee in all of Germany over this period. We see where they work, how much they earn, who they are, the education levels, and so on. So it's quite a powerful data set. Several tens of millions of workers in this data every year. We're going to combine this with firm-level balance sheet data from Amadeus, of the kind that many here will be familiar with. And then we will hand match this with information on syndicated loans in a database called DealScan, as well as more recently in an extension also with non-syndicated smaller loans that we hand match into these other data in order to identify which banks lend to what firms. So after putting together these different data sets, which in itself was a bit of work that went into this, and we're super excited to have done this for the first time, I believe, in history, we're now ready to study the full link from firm-bank relationships into firm financials, and then finally into what happens with workers that are employed at those firms. Table of summary statistics. There's a lot more numbers than you will be able to digest within the couple of seconds that I'll flash this. I just want to point out that measured by sales, assets, and number of employees, these are fairly large firms. Why is that? Not because in Germany all firms happen to be 1 million or 200 million in assets and larger. No. It's because within the pool of German firms, we're looking here at ones that received a syndicated loan. Syndicated loans are a serious business. You must be pretty large in order to get one of those. So that's a sample restriction that we're working with at the moment. So what does monetary policy do in this setting in Germany? The first finding, and that's the first key step, is that we find an overall negative credit supply shock of the induced by high deposit banks after June 2014, lending less to the firms that they have pre-existing relationships with. So overall, there's a negative effect on credit in the economy due to these negative rates at the ECB level. Primarily low risk or return on asset volatility firms receive a big credit cut. Higher risk firms, high ROA volatility firms, experience a less pronounced effect, closer to zero. This is going to be our first stage in the sense that now we have just found out that some firms get more credit cut relative to others. So now let's talk about the effects of this credit cut on some firms but not others on wage inequality. This graph on this slide contains quite a bit, but it's really everything that I want to show you today. So let me decipher this and go through this together. What are we showing you here? On the x-axis, I am ranking my workers in Germany, you know, the tens of millions that I observe, from the lowest income percentile, 0, all the way to the highest income percentile, 100. Then I'm showing you 3 lines that show you the log change in wages between before the cut before the negative rates happened and after. What are those 3 lines? The blue in the background is showing you the overall change in wages of these different individuals ranked by their initial income. The blue line is a little bit wiggly, but round about 0. That means over this period, we see that wages didn't move all too much. But it's coming from 2 offsetting effects that I masked, namely the green and the red line. What is the red line first? This is how much individual firms that employees of a given income percentile were employed at, how much these firms increased their overall pay. And you see roughly that this red line is downward sloping. It starts out fairly high in positive territory, and it enters negative numbers towards the highest income percentiles. What does this mean? It says that in response to the negative ECB rates, the lowest paid employees, their firms increase pay. Whereas the highest, initially highest paid employees, their firms actually cut wages. Downward sloping red line, you might see now as well that the green line in turn is upward sloping. What does that mean? That means that within firm inequality, relatively went down among the lowest paid employees, relatively went up among the highest paid employees. So to summarize, there's really 2 very interesting offsetting effects. One is that between firm inequality goes down, here shown by the downward sloping red line. Firms now pay more equally to one another. But at the same time, within firm inequality, here the green line is going up. I want to formalize this in just a couple of more elaborate regression analyses. But essentially, if you just take one thing from this presentation, it was what I just showed you as the punchline of today's talk. All right, so just to put a little bit more meat on this, what we're doing here is a classical labor economics exercise. We're trying to explain log wages of a worker I that works at firm J in year T. And we're going to explain that in a regression framework by projecting it onto a couple of indicators and controls on the right-hand side. The main thing that we are interested in is this beta 1 coefficient that tells you how a relatively higher deposit ratio bank after 2014 increased or decreased credit that then changed the pay of someone who is either initially low paid, middle paid, or the omitted category here being high paid. What do we find from estimating this equation? The results are in this table. I want you to focus just on the first column for now. What we're seeing here is that the first row shows you the banks and their client firms that had most skin in the game, reduced credit the most, after 2014, increased their average pay by more relative to the other categories, that is, relative to higher paid employees. So again, to summarize, in line with the graph that I showed you 2 slides ago, If you were initially at a low-paying firm, that means now you get paid more after these negative interest rates. There's different channels through which your pay can go up. I mentioned earlier, either your current employer increases pay, or you're able to maybe find a higher paying employer. So we're interested in which of these two it is. In order to get at that, we're going to follow a two-stage procedure. We first decompose log wages of all the individuals in the data, and then we want to ask precisely that question. Is it that the pay of low-paying firms went up? Or is it that the distribution of workers shifted? That means people found new employment opportunities. What we find is that out of the overall effect on the last slide, if I were to fix firm pay, the effect of, that is here highlighted by this negative 0.131, the effect of fixing firm pay is essentially explaining all of this number. Conversely, if there had been no worker mobility, that means after the negative interest rate, suppose that no one was allowed to switch jobs anymore, if anything, it would have gone in the opposite direction. So the key takeaway here is that yes, firms actually changed how much they pay in response to this credit supply shock through negative rates at the ECB level. And then the last thing that I want to show you is what happens within firms, because I think there's a lot of interesting action going on as well. What do we do here? We follow a so-called difference in difference setup and estimation, in which on the left-hand side of my estimation equation, I'm going to have an inequality measure within the firm. Think of that as being like CEO pay to middle worker pay. And then on the right-hand side, I'm going to have the same indicators for, how much affected you were by the negative ECB deposit rates and other controls. In a picture, here is what we find. The red line is showing you over the years 2010 to 16 how much the bottom 25% within any company earned. The green line is showing you how much the top 25% within any firm earned. They fluctuate around by a little bit, but move broadly in parallel up until this point in 2014, when they start to diverge at the same time that negative rates were introduced at the ECB level. This suggests that within firm inequality, that is how much someone at the top versus at the bottom gets paid, might have actually started to diverge because of negative rates. Now this is just a picture, you can do the econometric analysis behind it, and we exactly confirm this hypothesis. Namely, we find that the 95th to 5th percentile, or the 90th to 10th percentile, significantly increased in response to this negative rate shock that affected credit supply. So with that, I want to wrap up. What did I show you today? I was starting out my talk by saying we should maybe try to understand better the distributional consequence of monetary policy. That's exactly what we did today in this project, and we're among the first to do this. It's sort of a nascent branch of research. We did this by studying negative interest rates in the Eurozone and exploring the fact that different banks were differentially exposed to these negative rates, and then looked at what happens to the workers within those firms in response. We found that within firm inequality actually goes up, while between firm inequality goes down in response to this credit supply shock. One of the key takeaways that I'm sort of taking from this project, and I hope you do too, is that there are significant redistributional consequences of monetary policy, that they can be subtle at times, maybe offsetting, but that there are winners and losers, even from monetary policy, which, I want to remind you one more time, by its mandate does not care about inequality. Thank you very much, and happy to take questions. Yes?
So you talked about the idea of winners and losers as a result of monetary policy. This seems like a pretty narrow swath of monetary policy universe, like the idea of a natural experiment solely focused on negative rates. Have you also observed this in low-rate United States over the last several years, or can we broaden the conclusions across geographies or across periods?
Yeah, that's very interesting. In terms of geographies, I don't think there's anything too special about the context that we study. I would love to replicate this for just about any country that I could get my hands on for their data. Unfortunately, the impossibility of combining worker level data with firm financial and the banking relationship data for the US makes this impossible at the moment. Now, how general is this as a scenario that we study? We do think that there is something special about negative interest rates for the reasons that I outlined. But you can think about many other things moving credit supply. And it's through that that we think there's a lot of generality in this. Yes, please.
I think on this last graph that you were showing, where you showed in 2014 the kind of increase in differential, moving more towards 2016, it started converging again. Do you have any views on why that is, and potentially anything beyond 2016 data to confirm or disconfirm?
Super interesting question. We right now are getting the 2017 data. They sort of roll in, you can imagine, as the Social Security Administration is assembling these data sets, if you will, live. So we have like our hand on the pulse. Our co-authors at that institute in Germany where we get the data from. So I'm going to have a definitive answer soon. For now, what you pointed out is, I think, also very interesting, which is that there was maybe some convergence again after a couple of years, once this shock had been around for some time. And I think that's maybe very reasonable that, after a couple of years, you've had the time as a company to change your worker composition. Workers have had the chance to find new employment. Wages have had a chance to adjust maybe back to their normal, quote-unquote, levels. And so this, closing of this initial effect, I think would not be against what you would expect in a world where things are allowed to adjust. Now, whether that's actually a persistent closing or whether that's more like a transitory fluctuation, I'm going to be able to tell you soon, hopefully. Question?
So there's a few people have historically talked about winners and losers from monetary policy in a lot of different ways. Debtors win from unexpected inflation, for instance, say, or unpegged interest rates. So I was wondering, is there any way you can create this into a general equilibrium framework where if you got like the individual balance sheet data, like some countries who have wealth taxes have that hacked the Social Security numbers, you could kind of figure out the different ways in which those interact, different effects of monetary policy.
Super interesting.
Yeah.
I would love to have like a sort of very holistic view of all the different actors in this economy. I focus today mostly on wage workers here. Why have I done that? Well, it turns out around 80% in Germany of people, like in the US, not too far from that, 80% of people have essentially net worth of zero. And then the top 20% of the population hold all the wealth. So, while that's not saying that these 20% are really important for all kinds of reasons, I wanted to focus here on maybe the understudied group of the lower 80%. That is not to say that I would not love to also know more about these guys at the top. It's just that the focus of this project was trying to fill, I think this other gap. And I'd love to understand this more and work more on it. Yes?
So two things that were kind of counterintuitive to me is one is that the higher ROA firms and the riskier firms kept getting credit but not the other ones.
Yeah.
And then the other one is the within firm wage inequality going up. I would have expected you saw a lot of layoffs, but not that at a certain point you couldn't lower wages anymore because the majority of low-paid people are already at minimum wage. Can you talk about that?
Both super interesting. Higher ROA volatility firms getting relatively more credit, although overall credit is being cut, tells you that these banks are reaching for yields. They have less, money to give out overall, and then they need to decide where to put it. Turns out that these banks decided to go for the high yield kind of, investment opportunities. So that could explain this high vol, relatively more credit effect that I showed you. The second thing that you asked is why is it that within firm inequality goes up? And there's, I think, two reasons. One I already alluded to, that is to say that these firms may be invested into capital technology machines that are more complementary to high-skilled individuals. Actually, we find something like that in the Amadeus firm financials data. But there's a second thing going on that is out of this pot of money that these firms now find themselves with, someone needs to decide where this money ends up going. And, as a function of people's replaceability, are the function of their outside options also, how keen they are to stay versus not. You may expect that certain parts of the workforce within a firm, you can cut more easily their wages relative to others. What we're finding here is that the wages of those at the top stay relatively high to those at the bottom, which tells you that maybe the guys at the bottom are easier to replace, and hence you as a manager might maybe think it's better to cut their wages relative to the management level and top management maybe.
But so those people aren't at minimum wage. We're talking about people that are being paid some kind of lower middle class level. Those people's wages.
Correct, and that's a good observation. And that is exactly because of the fact that we study pretty large firms here. Large firms already pay a premium over your local mom and pop store at the corner. So there's room for downward movement. Other question? Very interesting. I worked at the Federal Reserve Bank here in the US at the central bank last spring, and while I was there, I would not have been allowed to make such statements. Since I'm now fully employed by Columbia again, I am going to say something. I think these things are tremendously important to understand for laymen as well as for policymakers, because they need to decide what are the consequences of their actions. Should the central bank take inequality into its objective? I don't want to take a stance on that. There's a lot of recent theories in economics why inequality might actually matter directly for macroeconomic outcomes like output, employment, growth, and so on. I think these theories need to be tested and quantified, and then maybe down the road the Fed might want to actually adjust its mandate, its objectives. For now, I'm sort of part of the group trying to build the groundwork for that, just laying out the facts so that people in policy circles can make informed decisions. Yes?
Do you think this income inequality increases, decreases, or keeps neutral, like the total wages paid in the economy?
So this I'm going to refer to this literature that I just mentioned in my previous answer. In the specific context of Germany and the negative rates here that we study, it's sort of a wash, since the blue line that I showed in the early graph was round about 0. But then more broadly, you may ask, is more or less income inequality, going to bolster growth or maybe hamper growth? And there's a lot of literature in recent years on that in economics. A lot of my colleagues working on this, and I think a lot of these theories remain to be tested. So I'm excited to sort of be part of it and hope we see this play out. Another question?
Are you able to assess the level of correlation between negative interest rates and this difference in wage over time? I mean, to what extent that could be due to other factors, which are not necessarily the negative interest rate?
Yeah, so that's a really important question for us researchers. At a fundamental level, the way, and it was a little bit hidden here in these econometric specifications, the way that we want to think about these effects here is by looking at a cross-sectional control group of people that we think are, reasonable to hold, that we can hold fixed over time. So the idea here is we're already doing our best in order to, find the real treatment effect of this negative rate, if you will, as opposed to what you suggest, there being some other correlation maybe with macro aggregate, dynamics over this period. So if you believe what we're doing, the methodology that should be taking care of that. Having said this, some of the things that we saw on the graph was, for example, that after 2, 3, 4 years, some of this initial widening in, say, the within firm inequality graph actually started to come back. And it takes a couple more years of data to really assess this, and we're working on that. I really hope I'm going to have an answer soon. Yeah?
You started off by talking about monetary policy as a response to an economic event. Do you have any data as to what would happen to inequality in wages if there was no monetary action in terms of not changing rates and how that would impact it?
That's a great question. So again, I view that as the next step to this research agenda. The first step is try to understand what the observed changes in monetary policy have done to the distribution of income. And that's kind of what I'm trying to help answer here, and what there's a new literature about that tries to answer this question. As a next sort of obvious and very fruitful step, I think, that would be to try to answer the question, what other kind of policies could you consider? What if you shut down all monetary policy altogether? I think that's an ambitious question. A lot of people around the world would love to know the answer, and I kind of view what we're doing as sort of the first step towards this.
Sorry, just linked to this question actually. Do you know what was the effect on wage inequality when there was an increase in interest rates in the past? Just to compare.
Good question. So we restrict here attention to the period 2010 to 16. By design, we don't really have super high interest rates, over this period. One could replicate this analysis for higher interest rate periods. My feeling, based on the reading of the literature and my co-author's previous work, is that high interest rate periods might look quite different from this. Why would that be the case? Well, because lowering a high positive rate is possible, both for the ECB, of course, but also for the commercial bank. They can just say, instead of paying you as the customer 5%, I'm going to pay you 4% now. But once you hit this, magic zero lower bound, it turns out these banks are reluctant or maybe unable to charge negative rates to you as the customer. And so that's the sense in which maybe the negative lower bound, zero lower bound, is somewhat special. But again, like I answered earlier, I think there's something more general in here about credit supply shocks through monetary policy or otherwise. Take one more question, then. Yes?
Result in opposite result, the fact would be symmetric, would be asymmetric.
Good question. That's something that we think about and that we're thinking about more, I think, going forward also. This definitely relates to this zero lower bound question. I think once you look at a positive shock that's so large that it brings you away from zero back into positive territory, I would expect quite different results, although as I mentioned, it's outside of our sample period. More generally, given the German labor market characteristics and institutions, you may expect that because it's hard to maybe cut wages, for example, in Germany, but even in Germany it's possible to raise wages pretty easily, that some of these effects may be asymmetric. As another example, it's quite costly to fire someone and find a replacement. It's quite not, by definition, not costly just to keep hiring someone, keep someone in the job. Although it may be costly also to hire another person. So I don't have a definitive answer. I'm just pointing out here that some of these effects, as you may, I think as you suggest, may be quite non-linear.
Because I'm thinking you can do that because I think there's quantitative easy in Europe. I think that can be a setting to examine the effect of lower rates and higher.
Absolutely. And I've been speaking with actually the Bank of Italy, not the ECB, about getting data to look at that. But sort of, again, one step at a time. So I totally agree, it'd be awesome. We've blended that out here in everything that we were doing, and it'd be super cool to study. I agree. All right. Thank you very much. And